Good afternoon, everyone. Thanks so much for joining us today. My name is Stephanie Creedon, and I'll be your host for today's webinar, Revenue Recognition Part 4, ACS 606 for Software Companies, Step 5, Recognizing Revenue. Before I introduce today's presenter, I'd like to go over some housekeeping items. Today's presentation will last about 45 minutes, and we will have time for questions at the end. The slideshow can be downloaded at www.wolfandco.com/webinars/2018. You have two options for audio today. You may dial in by phone or listen through your computer. Our audience will be muted during the session, so if you do have questions at any point, please send them in to me by using the questions box located on the webinar's control panel. We will be taking questions at the end of the presentation. I'd now like to give a brief background of the firm. Wolf & Company was established in 1911 and have 2 centuries of experience providing our clients with assurance, tax, business consulting, and risk management services. We have over 250 professionals working for the firm and have offices in Boston and Springfield, Massachusetts, Albany, New York, and Livingston, New Jersey. It's now my pleasure to introduce today's presenters, Scott Goodwin and Cecilia Frouette. Scott serves as a member of the firm and technology services team leader. Cecilia is an audit principal and software sector leader. Thank you both for presenting today, and I'll now hand the presentation over to Scott to get started.
Great, thanks Stephanie, and thanks everyone for joining us today. We're on the home stretch here. We're on to step 5. So what we're going to cover today is the sort of culmination of the 5-step process here. So talking about how revenue actually gets recognized. And Cecilia is going to be talking about a couple of important concepts there, over time versus point in time. And then of specific interest to software companies is going to be the licenses of intellectual property, with a sort of subset of that being some sales and usage-based royalty issues. I'm going to cover some specifics around SaaS subscriptions, and then we'll tackle one final topic, principal versus agent consideration. So without further ado, let's jump right into it.
Great, thank you, Scott. So as we do each webinar, we wanted to highlight the model, and as a reminder, 606 is a principles-based standard with a FASB-built 5 steps to help us all achieve that principle. And as you can see there, the core principle or concept is to recognize revenue in a way that depicts the transferring of promised goods or services for the right to receive consideration. So the good news is that we made it all the way to step 5. So today we're going to talk about recognizing revenue. So under the new standard, an entity recognizes revenue only when it satisfies a performance obligation. Now this occurs when a good or service is transferred and the customer obtains control over that good or service. So I'll pause there to add emphasis on the fact that the key concept of control. There has to be transfer of control. So the standard notes that control can be transferred either at a point in time or over time. And the standard is fairly prescriptive here in that the rules require that an entity evaluate if overtime criteria are met. Then, if none of the overtime criteria are met, revenue is going to be recognized at a point in time. So, how do you evaluate if you meet the overtime criteria? We have the bullets listed there. So the first one, the customer is benefiting as the performance occurs. Number 2, you're creating or enhancing an asset that the customer controls. And number 3, the entity performance does not create an asset with alternative use. However, the entity has the right to payment for the work done to date. So as you look at those 3 criteria, you may be able to kind of quickly infer, generally speaking, that services are going to be recognized over time, and goods are generally going to be recognized at a point in time. So, not a big conceptual shift here from how things are happening today, but these are the general rules. And there are specific rules about the timing of revenue recognition that software companies must consider. For software companies, what I'm referring to is the license of intellectual property guidance, which asks if the sales arrangement includes a distinct license of intellectual property. So in general terms, a license arrangement is one that establishes the customer's rights related to the company's intellectual property and the obligations of the company to provide those rights. The new standard provides specific guidance to help companies determine when control transfers for distinct licenses of intellectual property based upon the nature of the promise to the customer. For a software company, every sales arrangement should be evaluated under this guidance. Generally, license of IP guidance will be applicable to both perpetual and term software licenses and not traditional SaaS arrangements. However, SaaS companies must go through the process of determining if their arrangement includes a license of IP. So you can't skip over this step in your white paper. You should address this, even if you're a SaaS company, address whether or not these rules apply to you. Okay, so in analyzing an arrangement with software, we wrote down 3 core questions that you'll need to ask as you move through the process. The first one being, does the arrangement include a license of IP? If so, is that license distinct? So here you notice we comment that VSOE is dead. So we've probably all heard this news before, but we'll address kind of how it fits into the greater context of license of IP and what the implications are. And then we'll also talk about licenses that are not distinct and what the consequences of that are. And then, if you have a distinct license, step 3 is going to be, is the license of IP functional or symbolic? So the type of license that you're selling. And then kind of a step 4 that's not noted on here, which we're going to cover, is the license of IP a sales or usage-based license? So that's a little bit more narrow, but we are going to cover that as we go through today. So now we're going to move through these kind of questions one by one. So, all right, step 1 is determining if a contract includes a promise of a license of IP. This would be straightforward for contracts that include licenses of on-premise software, but similar to today, the evaluation for hosting services is a bit more complicated. The 2 criteria for a license are listed out here: that the customer has the contractual right to take possession of the software without significant penalty, and that the customer or another vendor can run the software on its own hardware. So these should look very familiar to you. The criteria for making this assessment in hosted arrangements were essentially carried forward. So it should look very similar to the decisions made today under 985 and 605. So essentially, the odds are if you sold software and you were under 985, you were selling a license of IP. And if you provide a SaaS solution and are currently under 605, you are not selling a license of IP, and you are going to be under the general revenue recognition rules, the ones I outlined just a few minutes ago. And you have to go through the overtime criteria first before recognizing a point in time. And Scott's going to touch on SaaS arrangements later. So for now, we're going to assume that you are selling a license of IP, and we're going to move through to step 2. So now you have to determine, is that license of IP distinct? So what does that mean? Meaning, is it a separate performance obligation? So this should also look familiar to you from earlier webinars. Hopefully you recall that to be distinct, a license must be both capable of being distinct and distinct within the context of the contract, or separately identifiable. A license is capable of being distinct if a customer can benefit from the license either on its own or together with resources that are readily available to the customer. If a license is capable of being distinct, it is evaluated to determine whether it is distinct within the context of the contract, and that is whether the nature of the promise is to transfer the license and other goods or services individually, or really to transfer a combined item, and essentially the license and other goods are just inputs into that combined item. So that should be fairly familiar to you, that evaluation. So now, other considerations. So on to VSOE. What happened to VSOE? So VSOE of fair value is no longer required to identify the unit of accounting, or now known as really as a performance obligation. And this may lead to the identification of additional performance obligations and earlier revenue recognition. So the question would be, when would that happen, right? When would you be recognizing revenue earlier? Well, remember that under the old guidance in 985, an entity can separately account for elements in the software licensing contract only if it has established VSOE, a fair value for the undelivered elements. The elimination of VSOE may not change the timing of revenue recognition for perpetual software licenses, as many companies have been able to establish VSOE for PCS as a result of having PCS renewals, and therefore they've been able to account for the perpetual software license and the PCS as separate elements. So the biggest impact here may be in term-based licenses. So under the new standard, a software vendor that provides a term-based software license bundled with PCS could determine that there are two distinct performance obligations. And under 985, entities have typically had to combine the elements in these contracts that include the coterminous term software license and the PCS because they weren't able to establish the VSOE of fair value for the PCS. And then because the software license has, so now we're maybe able to separate those two things, and then because the software license has standalone functionality, revenue was going to be recognized at the point in time when control transfers. So we're going to talk more about standalone functionality and its impact on revenue recognition in a few slides, but just to highlight that the impact of VSOE really relates to term-based licenses. So to conclude on step 2, if you have a distinct license of IP, which is now more likely than in the past, you need to move on to the next step and determine what type of license of IP you have, symbolic or functional. And if you don't have a distinct license, you need to consider the best way to measure progress of the transfer of control of that performance obligation, and you're essentially going to go back to the general guidance regarding overtime and point in time. So now let's kind of take a break and look at some examples together. So scenario 1. So SampleCo enters into a contract with WorkCo for on-premise data analysis software and cloud data storage. The software utilizes WorkCo's data stored on the cloud to provide data analysis. The software can also utilize data stored on WorkCo's premises or data stored by another vendor. So is this license going to be considered distinct? So the answer here is yes, the license is distinct. The reason it's distinct is that the software license and the cloud data storage service are not highly interrelated or interdependent. If the data is stored on WorkCo's premises or with another vendor, then WorkCo would still get all of the benefits of the software. It's a key point. And the cloud data storage could be provided by other vendors and is capable of being distinct. So another example here, scenario 2. So again, SampleCo contracts with WorkCo for a perpetual software license, for installation services, and for 2 years of technical support. Here, the installation services include significant customization of the software to interface with WorkCo's data sources. The technical support is not critical to maintaining the ongoing utility of the software. So in this scenario, is the license distinct? Hopefully these are fairly straightforward based upon earlier webinars on the concepts of distinct, but here the answer is no, right? The software is not distinct from the installation services because the installation services significantly customize the software. So really the software and installation services are creating a combined output. So the customer is really being promised a customized software solution. So here the license is not distinct. So you need to go back to the point in time versus overtime criteria that we outlined at the beginning of this presentation and really decide, is control transferred at a point in time, so once the software is completed, or over time as the customization is performed. It's going to be more facts and circumstances based. And regarding the tech support, it is distinct, and that can be recognized, should be recognized over the term, right? And that's distinct because the technical support is not critical to maintaining the ongoing utility of the software. Okay, so now we're moving on to the third question. Is the license going to be considered functional or symbolic? So the standard states that companies provide their customers with either a right to access the entity's intellectual property as it exists throughout the license period, including any changes to that intellectual property. A right to access license is going to be your symbolic license, or you're given a right to use license, and that's really the right to use the entity's intellectual property as it exists at the point in time in which the license is granted. So these are going to be your functional licenses. So right to access is symbolic, right to use is functional. So if you flip to the next slide here, we've put together a summary of these two different types of licenses. So starting with the functional, your functional IP is defined as IP that has significant standalone functionality. For example, the ability to process a transaction, perform a function or a task, be played or aired. And so because software has the ability to process transactions or perform specified functions or tasks, it is considered to have significant standalone functionality. And therefore, it's pretty much always going to be your functional IP. And so functional IP is recognized as at a point in time. And then if we kind of contrast that with symbolic is just the opposite. It does not have significant standalone functionality. Really, the utility is coming from the symbolism from the entity's past or ongoing activities. And these are your brands, your logos, and it's symbolic because the entity really has an obligation to continue to support and maintain the IP over time. Therefore, revenue is going to be recognized over time as you kind of earn that revenue. So let's go through an example here. So SampleCo provides a 5-year term software license to WorkCo. The terms of the arrangement allow WorkCo to download the software by using a key provided by SampleCo. WorkCo can use the software on its own server, and the software is functional when it transfers to WorkCo. WorkCo can also purchase post-contract customer support, so PCS, with the software license. The license and PCS are distinct, as WorkCo can benefit from the license on its own, and the license is separable from the PCS. So how should revenue be recognized from the license? So the IP underlying the license in this example is functional IP because the software has significant standalone functionality. So SampleCo will get to recognize the revenue at a point in time when WorkCo is able to use and benefit from the license. So no earlier than the beginning of the license terms. And PCS is a separate performance obligation in this arrangement and does not impact the assessment of the nature of the license. So this one was really to point out to you that this is a 5-year term-based software license. And you can see the conclusion here is that we're getting to recognize revenue at a point in time when that term license is transferred, which would be a significant difference from today. And we would likely have to recognize the revenue from that term license over that 5-year period. So today you're going to recognizing it all at that initial transfer, day one. So now if we move on, so the last item to kind of think about here is if you have a sales or usage-based license. So licenses of IP frequently include fees that are based on the customer's subsequent usage of the IP or sale of products that contain the IP. And there are now specific rules and revenue recognition for these sales or usage-based licenses need to follow these rules. So when would this apply to you? So when the sole or predominant item to which the royalty relates in a license of IP, when the sole or predominant item to which the royalty relates is the license of IP, then you would need to follow the rule regarding the recognition constraint under the sales or usage-based license. So the rule is that you would recognize revenue as the sale or usage occurs, unless doing so accelerates revenue ahead of the satisfaction of the related performance obligation. So this is not considered to be variable consideration. So under step 3, if you recall, which is determining the transaction price, that's kind of where the guidance lives for variable consideration. So that's not where we are. Rather, this is considered to be a recognition constraint. So there's a bullet here about estimating usage. And essentially what this is doing is removing the ability to recognize revenue on a lag, right? If information is not available, you're going to have to estimate your customer's usage. Some contracts will also contain royalty minimums, and therefore you would need to consider these minimums fixed and earned upon satisfaction of the performance obligation. So these rules only apply to license of IP when there's a royalty and the predominant item to which the royalty relates is the license of IP. So these rules are not going to be applied to other circumstances. So in other scenarios, you could have a sales or usage-based royalty received in an arrangement, but it's not a license of IP. So then it would be fall under the variable consideration in step 3 when you're determining the transaction price. So now I think I have an example for that. So Sample Co. Licenses software on an annual basis to its customers and promises to provide training on the use of the software. So in exchange for the software license and training, the customer promises to pay Sample Co. $1 per transaction process. Sample Co. concludes that the software license and training are each distinct. So does this sales or usage-based royalty does the sales or usage-based royalty guidance apply to this particular arrangement? So because we're talking about software licenses here, as you might think, yes, the answer is yes. The license of IP is predominant in the arrangement because the customer would ascribe significantly more value to the software license than the training, right? That's what they're really paying the royalty for. So therefore, Sample Co. is going to recognize the revenue as the usage occurs, assuming that this does not accelerate revenue ahead of satisfying the performance obligation. I'm going to go to my final example here. Sample Co. licenses patented software for a term of 3 years with no upfront fee and 1% of future product sales. However, Sample Co. is entitled to at least $5 million at the end of each year, regardless of actual sales. So a 3-year term for essentially $15 million plus royalties of 1%. So technology in this area is changing rapidly, and the possible consideration from the product sales, the 1% royalty, ranges anywhere from 0 to $25 million, depending on whether new technology is developed. So management has concluded that the license transfers at a point in time when the license period commences. Management has also concluded it is probable it will be able to collect the consideration to which it's entitled, and there are no further obligations remaining after the license is transferred. So now knowing what we know about sales and usage-based licenses, how would Sample Co. account for this transaction? So Sample Co. will recognize the royalty revenue when the future product sales occur, right, the 1%. However, because Sample Co. is entitled to at least $5 million at the end of each year, this is fixed and not variable. Therefore, Sample Co. would recognize as revenue the fixed amount, the minimum payment of $15 million at license inception. So then any consideration from the royalties in excess of the $5 million in any given year would be recognized as those sales occur. Hopefully those examples help to clarify the sales and usage-based rules. So then what we put in last is just kind of the flow chart or decision tree of what we just walked through. So this could be hopefully a nice quick reference as to how to move through the yes/no answers of, do you have a license of IP? Is that license distinct? What type of license is it? And then, is it a sales or usage-based royalty license? So,
excuse me. So I think that that slide nicely encapsulates some of the complexity you just walked through. So thank you for that. One thing that I just want to make sure I understand is just the implications of vendor-specific objective evidence going away at VSOE. So you talked about the impact on what would happen in a term license situation, that impact would be very dramatic, change from old GAAP to new GAAP. But if you're a perpetual license seller who never was able to achieve VSOE for the PCS, it's going to have a very dramatic impact on them as well. Okay, so anyone who never was able to hit the very high VSOE threshold, you're going to have a big change in your revenue recognition.
Yep, that's correct. And if I'm remembering correctly, an example of that term license impact might be Microsoft. So if you looked at their 10K upon adoption, I believe there were some changes for their accounting for term licenses.
Interesting. Okay, so now we're going to, thank you for that, Cecilia. We're going to switch gears here a little bit and start focusing on some of the specific issues related to SaaS subscriptions in this step 5. So, you know, this is probably, for all you pure SaaS companies out there, this is probably the question you've been waiting to have answered or confirmed. So, is a performance obligation to provide software as a service satisfied over time? Excuse me. And in general, the answer is yes. And why is that? So think back to the 3 criteria that Cecilia laid out on slide 7. The customer in an arrangement like this will typically consume and receive the benefit throughout the contract period based on the SaaS providers providing access to the hosted software. So if that sounds familiar, it's because it's basically criteria 1 back on the 3 criteria. And said another way, it's the customer in a SaaS arrangement receives that benefit throughout the arrangement period for having the ability to access the hosted software. And I emphasize the ability to access. And you know, Cecilia mentioned that this is going to be similar to other service type contracts, whether it's a contract for a cell plan or home cable or internet service or anything like that. It doesn't matter how much your customer utilizes the SaaS software or how much TV or internet you use. It is your ability to turn on your phone, turn on your TV, or open up the SaaS platform and have access to it that is the important part. And that is why in most instances, a pure SaaS will be an overtime performance obligation. Okay, so now let's consider the treatment for some of the services that you may perform related to a SaaS arrangement. So, is a performance obligation to provide implementation services in a SaaS arrangement satisfied over time? And just for purposes of this example, we're only looking at the service piece, not a bundle. Again, here the answer is in general yes. It would be satisfied over time. You know, the reason for that, things get a little complicated here, but if you think about a common SaaS implementation service, it will frequently create an asset for a customer. So, for example, if a SaaS provider is developing custom software features, an API connector or something like that for a customer, those costs will create an asset for the customer in accordance with subtopic 35040, the internally developed software rules. In those cases, the entity would probably conclude that its service creates or enhances an asset that the customer controls as the entity performs, and therefore the performance obligation is satisfied over time. That, what I just described, is the second criteria for an overtime performance obligation that Cecilia covered on slide 7. Other SaaS implementation services will not create or enhance an asset controlled by the customer. And even if that's the case, it could still be that would be performance obligation satisfied over time. And how is that? If the services will not create an asset for the customer and would not need to be performed in the hypothetical scenario where another service provider would be engaged if the entity does not complete the service in full, then the customer consumes and receives the benefit from the services as the entity performs, and therefore, again, the performance obligation is satisfied over time. And that's the first criterion back on Cecilia's slide 7. And I know that's a mouthful, and we're going to go through an example of that because I think the concepts, once you see it, will be clearer when we walk through an example. So most common SaaS implementation services are going to fit into one of those 2 buckets and would therefore be satisfied over time. However, for any service that does not meet one of the first two overtime criteria, that service may still be satisfied over time if it meets the third overtime criteria. And that third overtime criterion is the entity's performance does not create an asset with alternative use to the entity, but the entity has an enforceable right to payment for performance to date. So what would be an example of that? So for example, if you were contracted to provide a consulting service to deliver a report on possible efficiencies the customer could gain from using the entity's SaaS platform, and you agreed that you would bill for the delivery of that report based on an hourly rate, even if you didn't complete that report, you would have the legally enforceable right to payment for the hours you incurred to date, and therefore that implementation or that consulting service would also be an overtime performance obligation. So, but not always. I can see why you would say, oh, great, all services are going to be an overtime performance obligation. The one thing I'll caution you on is just that it's important to distinguish between setup activities from implementation services. And you may remember from the discussion around step 2 of identifying performance obligations that setup activities cannot be a performance obligation, and therefore they would never get to this step 5 point of being assessed for overtime or point-in-time satisfaction. They would ultimately get combined with some other performance obligation and evaluated in that context. Okay, so let's look at an example that deals with some of these issues. So you've got a SaaS co that enters into a 3-year SaaS arrangement with customer. Customer agrees to pay quarterly fixed amounts. SaaS co also agrees to provide some services, training, data migration, and building an interface to the customer's general ledger system. SaaS co's concluded that each service meets the definition of a performance obligation. The interface will reside on the customer's network and will represent an asset for the customer. Other services do not create assets. So the question here is, which of these performance obligations are overtime performance obligations? So let's look at each of those services individually. So in the case of the services to develop the GL interface, SaaS co's performance creates an internal use software asset for the customer. That customer controls as the SaaS co performs. So that's satisfied over time. That's a sort of black and white example of the second criterion for overtime. The other services, in the case of training and data migration, data conversion or data migration, the customer consumes and receives the benefits from each of those services as SaaS co performs. Why? Because another entity would not need to re-perform SaaS co's work if SaaS co were to discontinue the services at any point. So this gets back to that convoluted concept I introduced a couple of slides back. So if you think about it, if I contracted to train your entire sales force and I got halfway through training or trained half your sales force and for whatever reason decided I could not or would not fulfill that obligation, if you had to engage another party to complete that training, you wouldn't have to retrain the first 50% of your sales force. So that is the indication, and the same with the data migration. If I migrated half your data over, you wouldn't have to re-migrate that data if I failed to migrate the remaining data. So that's the concept around consuming as it's delivered and is therefore an overtime performance obligation. So those are the services. Don't forget, you also have the SaaS service, and as we discussed on the first slide, your SaaS arrangement, your performance obligation to provide the SaaS is satisfied over time, since the customer receives and consumes the benefit as delivered. Okay, so that sort of wraps up the SaaS specific considerations for overtime versus point in time. We just wanted to work in one other topic which is this principal versus agent consideration. And this is a concept that has existed under current GAAP, so it may sound familiar to you, but the reason this distinction is important is because it relates to situations where there are more than two parties in an arrangement. And I'm sure you can think of lots of them. If you're, an auction website, you've got you're standing in the middle between the buyer and the seller, and there are three parties involved in that. But there are lots of other situations, and we'll go through an example. But this guidance determines who gets to recognize the revenue, gross versus net. And that can be pretty important for, determining not just your revenue, but your gross margins. So if you're determined to be the principal, you have the full amount of the transaction as revenue and then a portion offsetting that as cost of sales or cost of goods sold. Whereas if you're the agent, you only recognize the net portion. So the economics of those two are very different. So looking at what got carried over from old GAAP into new GAAP, it's very similar. There is one exception in that there was elimination of the requirement to consider the credit risk as an indicator of who is the principal and who is the agent. There is one new sort of qualitative focus of this analysis, and it has to do with evaluating who obtains control of the goods or services before transferring to the customer. And that control concept should sound familiar to you because it's one of the underlying principles of the entire 606 revenue standard, which is, revenue should reflect the transference of control to the customer. So it makes sense that when you're trying to determine who is the principal in this transaction, it would be who obtained control of those goods or services before transferring them to the customer. And I would just emphasize here that control needs to be substantive. Just because you put a provision into an agreement that says, party A momentarily takes legal title to the good before transferring it to party B, that may be considered to be non-substantive. So the three, remaining important criteria to consider are outlined there. Who has the primary responsibility for providing the good or service? Who assumes inventory risk? And who has the discretion in setting prices? And then finally, just a reminder that you have to evaluate each promised good or service or performance obligation separately. So it's entirely possible that you could have an arrangement that has 4 performance obligations, and 3 of them you're determined to be the principal, and 1 of them you're determined to be the agent. It's not on a higher level than performance obligation. So let's look at an example of that. So here we have SaaS Sample Co. provides customer with cloud data storage services. Those services include access to a third party's SaaS product. Sample Co. contracts directly with that third party for the right to access that SaaS platform. Sample Co. provides significant services related to integrating that product and delivering an integrated service. Therefore, the customer contract contains a single performance obligation, as the SaaS and the other services are not separately identifiable. So in this case, is Sample Co. the principal or the agent for the cloud services? So I would say in this case, Sample Co. appears to be the principal. So the SaaS is only one of several parts of a combined service that Sample Co. is offering to the customer. Sample Co. clearly obtains control of the SaaS platform. That they don't just pass it along to the customer unchanged as part of their integrated offering. And Sample Co. uses those inputs, including the SaaS platform, to create and deliver an integrated output. So now if we look back to those 3 factors that I outlined, certainly it seems like Sample Co. has the primary responsibility for providing the integrated services. It certainly isn't the third-party SaaS company. And it appears that Sample Co. has the discretion to set pricing. Now, I could I could definitely develop a fact set similar to this where Sample Co was not the principal. So for example, if Sample Co simply resold the SaaS without any significant integration, I think you'd have to say that they were not the principal in that. Or if the SaaS was optional, you could buy the cloud storage with or without it, and Sample Co was essentially just reselling the SaaS product if you wanted it in addition. I think it's likely that in that scenario, the Sample Co would not be the principal. So I think that just about wraps us up. How are we doing on questions? Okay. So Cecilia, I got one here that I think's up your alley.
Okay.
It says renewal of term licenses. How do those work? 3-year term with a 3-year renewal.
Okay. So we're going to assume we're talking about license of IP. So the time we spent talking about the term licenses of IP, where you get to recognize revenue on day one. So in this instance, the original term is 3 years. So you would recognize the revenue related to that 3-year term when the license is transferred on day one. But you can't recognize the renewal piece until you get to that renewal date and the customer exercises the renewal and really has the benefit of that renewal in the additional 3 years. So even though you've it may seem like, oh, can I recognize all 6 years on day one? No, you have to wait until the renewal period starts in order to recognize revenue. So I think that's what they're getting at. Hopefully that answers the question.
All right.
All right, so it looks like we've got one here on SaaS. So I sell a SaaS application with a 90-day customer acceptance clause. How does this impact revenue recognition?
Okay. I think that's a good question, because customer acceptance provisions definitely can affect performance obligations that are satisfied over time. So I think in cases like this, you need to consider the level of uncertainty around the customer actually accepting or not accepting the product or service. And that uncertainty can kind of run the gamut from what I would describe as substantive uncertainty about whether or not you're going to be able to meet the acceptance provisions. If you feel like you're at that level, you would probably be precluded from recognizing revenue over time. You'd have to wait until that uncertainty was resolved. On the other end of the spectrum, if you have significant experience with meeting customer acceptance provisions like this, they're really more perfunctory than anything. Then that customer acceptance would probably not impact your overtime revenue recognition. And I think that's handled similarly to today, the way we handle, the right of return. If you have the ability to accurately forecast that, it doesn't impact your revenue recognition. Whereas if you have no idea how many are going to come back, you may have to wait to recognize the revenue. And of course, between those two extremes, substantive uncertainty to being a little bit more perfunctory, or you having significant experience, I think there are lots of situations in between those two ends. So you'd have to evaluate where you thought you fell.
Okay, and then Scott, it looks like we have one on another one on SaaS. So it says, I am a reseller of a SaaS application. Will I still report revenue on a gross basis? So reseller.
Okay. In general, I'm going to say no. I mean, if reseller arrangements, I think, can run the gamut, but if you're purely a reseller, meaning you're essentially functioning as the sales arm of a SaaS company, then I don't see how you meet the criteria for principal or gross revenue recognition. You're not primarily responsible for delivering that good or service. I think that would fall to the SaaS company. I don't know if inventory risk, that may or may not be applicable in a SaaS reseller situation. And then the pricing, the ability to set pricing. Your ability to set pricing as a reseller may be fairly limited, but again, every principal versus agent analysis is all based on facts and circumstances. I just think it's harder. It's going to be harder for a pure reseller to meet those principal and gross revenue recognition requirements.
Great. So we don't have any further questions. If anybody does have any questions following the conclusion of this webinar, please reach out to Scott or Cecilia directly. Their contact information is listed on the current slide. And copies of today's presentation are available at www.wolfandco.com/webinars/2018. I will also be posting a recording of this presentation to the same web address later on today. And immediately following the conclusion of this webinar, you'll have the opportunity to complete a survey. As always, we appreciate your feedback so that we can continue to improve our webinar program. Thank you so much for attending today, and we look forward to your participation in future webinars. Have a great afternoon, everyone.